Hey everyone, the Geeks of Finance here. In this video, we're going to take a look at one of the most successful strategies that we've used in our educational portfolio, which is an asymmetric risk-reward methodology using gamma exposure. I know that sounds complicated, but it's actually pretty straightforward. So we'll show you guys how the strategy works, how we use gamma exposure, and we'll go through some examples that we added in our portfolio over the past several months. And we actually started tracking our educational portfolio back in February. So looking here at the dates from February to April, today's April 22nd, our total P&L is over $10,000 on a $10,000 account. However, some of those positions are still open, so our actual closed P&L is around $6,000. It's been about 20% returns for the months of February, March, and April in each of those months. Average winner is the key. Our average winner is bigger than our average loser going to this asymmetric risk reward methodology.
Do we know how many trades, the number of transactions constitutes? Because I know we use option combinations for a lot of these trades. And, I feel like we haven't done a whole lot of trading to get those results compared to some periods in time.
Yeah, that's right. Number of transactions, 190. That's not actually the number of trades because a lot of our option strategies are multi-legged option positions. And so the actual number of positions, which it's got right here, is 37. So basically
Yeah,
30, you can think of it as 37 round trip trades over the course of February, March, and up to this point in April. So here we're looking at the month of February. We had obviously just over 50%. I think we had 7 wins and 6 losses. Total realized P&L for the month of February, though, was over $2,000. So 20% return on our $10,000 education portfolio. And you can see our strategies here. We've kind of got a mix of butterflies, put credit spreads, call debit spreads, etc. So we kind of have a various mix with various expiration dates. We like to stagger our portfolio as positions roll off. We add new positions further out in time. And so that's our approach to managing an ongoing portfolio of option positions.
we had both long and short positions. So,
Yes.
we weren't necessarily guessing exactly the direction the market was going to go as much as just looking at individual setups and, going with what the risk reward said was the best.
Yeah, that's right. I mean, we had a long directional bias based on gamma exposure in the month of February, for example, but we were still hedging. Like if you look at this QQQ position down here at the bottom, we had a long put debit spread on through the whole month of February, which cost us $1,100. You can see there we lost the full amount basically of that hedge or near the full amount of that hedge. And this is how we manage our risk. Even though our bias was to the upside and we took a number of long biased positions, we still were hedging not only with the Qs, but we also hedged on a number of different specific positions. So same thing in March, we had a number of different positions that we closed out in the month of March. Total realized P&L was over $2,000 on a $10,000 portfolio. We basically reset the portfolio account each month. We're not compounding our wins here, but just to show how you can manage, a short-term options portfolio. And you can also see our days in the trade here, basically ranging from anywhere from 3 days upwards of 30 or 60 days at some times. And again, a number of different staggered strategies, right? Call debit spreads, iron condors, butterflies, and we stagger those various strategies based on gamma exposure. So some are bullish, some are bearish, some are neutral, and this gives us our overall asymmetric risk reward profile. So here's April. Today's April 22nd as of the time of this recording. So we've only closed out 4 positions. We have another several positions that had just expired over the weekend. And so those will be adding here. Several of those were losses, but we are still up over $3,700 in closed positions for the month of April so far. So we expect another 20% plus month in the month of April at a minimum. Again, various strategies. You can see this custom strategy on Tesla here was actually a double diagonal. I think that was the first one we had done here since we started tracking this educational portfolio. We've got a couple of butterflies and a vertical long call position. So you might ask, how are we deciding what trades to put in the portfolio? How do we do our research? And we're going to go through a few examples of that. So we use our gamma exposure dashboard as the basis for our research. If you're not familiar, we have a number of videos on our YouTube channel educating on the gamma exposure process. But basically, we're looking at data from the options market, calculating gamma exposure, and identifying where market participants and option dealers are concentrated in their positioning. So, for example, here we're looking at the SPY, and you can see we've got big concentrations here at the 495 and the 490 strike, SPY trading at 498 currently. And so gamma exposure can help identify where potential targets are and whether the market is positioned bullish, bearish, or neutral. We're not trying to catch absolute tops and bottoms. This is more about looking at the market positioning, which gamma exposure allows us to do. It allows us to see where the concentrations are of market participants. So just looking here at the SPY, we can see there is a lot of people concentrated, and this would be actually negative gamma exposure here at the 490 strike and the 495 strike. So because of that, we can form specific option strategies targeting those strikes. And you could do this even if you're an equities trader, right? Like you can use gamma exposure to determine your either day trading or short-term trade decision making and target analysis based on gamma exposure. So one of the first things we do when we're looking at gamma exposure is we try to get a sense of the overall market environment. And so we'll take a look, for example, at the SPY back in early February. Gamma exposure was very positive, which suggested that the market was in a buy the dip mode. We also saw that gamma exposure was concentrated between 495 and 500 at this point in time. And of course, the SPY was trading, right here at 492. And so, for example, we want to come in and put on some long positions. So it gives us an broad overview of what direction do we think over the coming days and weeks that the market is going to take. So that's step one of our gamma exposure analysis. So let's take a look at an example idea that we had incorporated in our portfolio. This was on snow. You can see here we were up around 880 bucks on this idea. It was a call debit spread. So it was a short-term trade with a short-term expiration. We entered the idea on February 6th. We closed it on February 9th, and it had a February 16th expiration date. So this was a quick in and out, but we saw an opportunity on this pullback.
And to kind of point out to our viewers some of the things that we were looking at, we have both that purple bar, which shows the gamma concentration at that level, which is the 220, and then you also see a large cluster at 230. And at the time that we posted this, we also saw volume at those levels. So all of that was coinciding with the price being close to 210 at the time. But as you can see, there wasn't much volume or gamma below that level. So there wasn't a lot of interest below that price. So we saw a good setup, as you pointed out. And sure enough, it didn't take more than a couple of days. So we ended up closing out that position on the 9th, and we closed 2 out of 3 on the 8th, and then the last one on the 9th, actually. So snow ended up working out really well. We ended up having a close to 100% return on capital at risk with that trade.
Yeah, I think it was like $700 risk, and we ended up closing out for a total of like 880. So a little over 100% return on that. Obviously, the risk reward here we're talking about in the options market, it can be substantial. So you can lose your entire amount or more if you're not careful with how you structure your options trade. So you definitely need to know what you're doing before you jump into options. But if you're a data-driven investor or trader, you have the potential to have high probability trades where even though the risk is large, the reward can also be large. So this was our idea on snow that we had in the portfolio. And I want you to take a look at something. We entered this, as I mentioned earlier, we entered this position on February 6th, but take a look at the hedge that we already had on in the portfolio. Down here at the bottom, you can see we entered into this QQQ put debit spread here on February 2nd. So we actually had downside protection if the market was to take a nasty turn. And so we have this like bifurcated portfolio where we're expecting the market to continue higher, and we're putting on positions like snow, for example. But we're also protecting our downside in the case that the market, for some unforeseen reason, was to pull back 3 to 5%. This QQQ position would have offset a lot of those losses and potentially even, depending on volatility, could have even still allowed us to be profitable. And that's how we conduct our risk reward assessment, making sure that we have the opportunity to profit in various outcomes. I mean, it's almost impossible to profit in every outcome, every market scenario, right? But if you can design your portfolio to profit in a number of likely market outcomes, you're going to do much better as a trader and as a portfolio manager. And so here in these two very simple scenarios, if the market was going to continue higher, it was likely that snow would continue higher because of the positive gamma exposure. If the market pulled back, it was likely that the Qs would see some profits in that position, which would help offset our long bias plays. And so this type of staggered approach where we're staggering our overall strategies, as you can see here, various different types of option strategies, different types of expiration dates. We've got February 16th, March 1st, etc. And, we've got different positions. We've got short bias plays, long bias plays. We have some neutral plays. And so that's kind of the staggered approach with asymmetric risk reward probabilities. That seems to have worked the best for us. It's one of our favorite strategies. It's how we manage our portfolio. And so I just wanted to share that with you guys with a few examples. Let's take a look at one more example. This time we'll take a look at GLD. This is actually in our March closed positions. On March 4th, we entered the GLD call debit spread. Another short-term trade. We actually closed that out within 3 days because it had such a significant move, locked in around $400.
So on GLD, we thought the 195 and 200 strikes looked like really solid targets, big positive gamma at those levels. And at the time that we placed the trade, even though the market had already started moving up for GLD, we ended up with the March 15 expiration because that's where we saw a lot of the gamma concentrated. And so we had both a price and a time that was our target. And we ended up only holding the trade for roughly 3 days before hitting those upside targets.
So that's a good overview of just kind of our basic strategy, how we use gamma exposure to identify concentrations at particular strike prices, how we stagger our portfolio. We're tracking this for our members, and we've been doing it, as you can see here, February, March, and April on a $10,000 educational portfolio. The purpose of the portfolio isn't for members to copy exactly what we do. Our members are formulating their own strategies. We actually have a 5-hour education course, and our members are able to learn and formulate the strategy that fits best with their risk reward profile. So really, the portfolio is just an extension of that education platform, helping our members to understand basic tenets of risk management, basic tenets of portfolio management, and how various option strategies can be used in conjunction with gamma exposure analysis. So if you guys are interested in learning more about how gamma exposure works, if you become a member, you get access to our 5-hour education course. We have an introduction to option strategy. We talk about how we use volatility, how gamma exposure works, as well as basic fundamentals of establishing an overall trading strategy. So you can come to our site, geeksoffinance.com. I'll put a link in the description below. Let me know in the comments section if you guys have any questions, and feel free to hop into our Discord, come by and say hi. We'd love to see you. Thanks so much, everybody, for watching. We'll see you guys in the next video.